Hi everyone, so welcome to my second video. Um, the first video we have talked about we have introduced ourselves to financial transactions on as far as bookkeeping is concerned. We talked about the basic principle of double entry. You have to debit the receiver and you have to credit the giver, and we looked into some transactions. So we are going to continue with these transactions. The transaction we did was for the first year, so we are going to continue with the second year in this video. So just now we're going to continue the second transaction for the second financial year. Now, like I told you, the basic principle of double entry is that you debit the receiver and you credit the giver. For every transaction, there is for every debit entry, there's always a corresponding credit entry, and for every credit entry there's always a corresponding debit entry. Once you are able to have a good knowledge of this principle of accounting, of this principle of double entry, then you are good to go in accounting. Accounting will be as easy, it will be very easy for you. So just endeavor to take your time to understand this principle of double entry and always apply it. That is why these transactions, once you go put them together, then I hope that you will be able to get the basic principle of double entry. Now let's move on with the transaction for the second financial year. And now, before we can start for the second financial year, you should know that the balances we have for in the first financial year, you have to transfer all of them down to the second financial year. And what do I mean by balance? If this is an account, this is for the first financial year. The difference between debit and credit side is what we call the balance. If the debit side is more than the credit side, you are going to have a debit balance. If the credit side is more than the debit side, you are going to have a credit balance. So that's just what balance means in accounting. The difference between the debit side and the credit side. Now, let us begin with the transaction for the second financial year. Now, the first transaction here is that payment to Curtis Clothes 3,850 from bank account. Payment to Curtis Clothes 3,850 from bank account. Like in the first financial year, we bought some items from Curtis Clothes on credit. Now in this second financial year, we want to make payment for what we bought on credit. When you buy something on account, it means you are buying it on credit. So I'll be making use of that term. I'll be making use of that term on credit. It means when you're buying on account, it means you're buying on credit. Now, when we make payment to Curtis Clothes from bank account, you're going to open your bank account and you're going to open, because you are making payment to our creditor, we are going to open payables account. You open your bank account and open your payables account. The bank account, is it going up or coming down? Is it increasing or decreasing? Our bank account here is from bank account, so it means our bank account is decreasing. So you are going to credit our bank account and you are going to debit our payables account. So I come here. The balance from the previous year for bank account is 13,000 naira. That's the balance. Now, then I'll credit my bank with payables of 3,850. That is why you see here that my bank is being credited with 3,850. My bank is credited with 3,850, and then my payables account will be debited. My payables account will be debited. Now I come here. This is my payables account. What was the balance from the previous year? The balance from the previous year was 3,850, but now it is now we have now brought it down to this financial year. So balance brought down in 3,850. So for the first transaction, we are going to debit payables account because our payables is reducing. So you are going to debit with 3,850. So that's just that for the first transaction. Now the second transaction, we made purchases. We purchase of goods from Rainbow Canvas 5,900 on account. We are making purchases from Rainbow 5,900 on account. Now when you're making purchases on account, you open for every transaction 2 accounts are involved. So for this transaction, we have 2 accounts involved. We have purchases account, and because it is on account, so it is on credit, so we are going to open payables account. We have purchases account and payables account. We already have purchases account from the previous financial year. So our balance for the previous financial year was balance brought down 3,950. So our balance for the previous financial year was 3,950, and now we are making additional purchase. We're making additional purchase, so we are going to debit our purchases account with how much? 5,900. So this is it. This is the balance from the previous year, which is balance brought down, and this is balance. This is purchases, a new purchases of 5,900. So I'm debiting purchases with payables of 5,900. So also I will not credit payables with purchases of 5,900. This is my payables. So the corresponding entry of this is this. So the corresponding entry of purchases is payables. So I've debited purchases, to I'll credit my payables with how much? Purchases of 5,900. 5,000. I hope you can see it clearly. Pardon me. 5,900. So it is just as simple as that. Now the next transaction pays the rent for premises 500 naira from bank account. We are paying rent for premises 500 naira. Sorry, pardon me. 500 euro from the bank account. Now there are two accounts involved. We have the bank account and we have the rent account. We are going to open the bank account and we are going to open the rent account. We already have a bank account and we already have a rent account from the previous year. Now the rent account from the previous year, what was the balance? How much was left during the previous financial year? The balance was 500 naira. So that balance, we are going to break it down to this financial year. So this is now the new balance, which is the balance brought down. The rent account balance brought down is 500 naira. So now we are now paying for another. We are paying rent again. We are paying another rent of 500 naira. So, and we are paying it from our bank account and rent account. So I'll call me bank 500 naira. This is a new transaction, bank of 500 naira. So I'll go to my bank account again and I will credit my bank because I'm making the payment from my bank. The payment of 500 was being made from the bank, so I'll credit my bank account with rent of 500 naira. So I come here, rent 500 naira. You can see this is the rent. This is the rent of 500 naira. Now receives money from an invoice 2,200 to the bank from last year. Now I'll take us back. I'll take us back to the last year financial transaction for number 12. Number 12 says that for the last year, we're told that we sold goods on credit for 2,200. Some goods are sold on account for 2,200, and now we are being told again last year we sold goods for 2,200 naira on credit. That is, we sold goods on account, but we didn't collect cash. It was on credit. And now this year, we are not getting payment for the goods we sold last year. We are not getting the payment now. So, and the payment is being made to our bank account. It is paid directly to our bank account. So, what are the two accounts involved? Because the payment is made to our bank account, we are going to open bank account and receivables account. We are going to open receivables account because the money it's a payment made by a debtor. It is a payment made by someone we have sold goods to on credit. Because when we sold goods on credit, we open receivables account. Now that we are going to receive the money too, we are still going to open receivables account. So, and I'll open my receivables account. What was the balance of receivables from the previous year? Yeah, the balance of receivable was 2,200. It was 2,200. So it was balance brought down 2,200. So this is the balance of receivables from the previous year, 2,200, and now we are paying receivables. So we are going to credit it now because our receivables they are paying to our bank account, so it means our receivables will reduce. So as a result, we are going to credit our receivables. How much? 2,200. So it's like they are offsetting that debt. So they they bought the payment on credit, and now they are making the payment. They are making the payment to our bank account. So I'll go to my bank account, debit it. How much? Receivables 2,200. So I'll debit my bank account and I'll credit my receivables account. So that's just how to do it for that transaction. Now the next transaction is this. Number 5, if takes money to private use 1,000 from company's bank account. So when you're investing money in the business, it is called equity. But when you're taking money out of the business, it is called drawings. So each takes money to private use. So because taking money from the business, it is called drawings. We call it drawings. So I will credit my bank account and I will debit my drawings account. Actually, there are two ways to do this. You can open equity account as well, and debit your equity account, and you can also open your drawings account, because eventually drawings will be used to reduce your equity account. So even if you like, you can open drawings account, and you like, you can continue to equity account. So but for me, I will prefer to open drawings account. So the two accounts involved are bank account and drawings account. So I'll come here, drawings. Yeah, so for this transaction, I think I believe there are two ways to it. You can either open Doris account and use the Doris account to reduce your equity account, or you take it straight to equity account. I think what Lisa did in class was that she didn't open Doris account, she used the equity account. So I will follow her approach. I'll continue with the equity account. So I will come here, open my equity account. The balance from the previous accounting year was 4,000 naira, and now we are taking 1,000 naira from the company. So I would debit my equity account. The money that we took from the company, is it cash or bank? It is bank. So I will credit my bank with equity of how much? 1,000 naira. So I'll credit my bank. So this is it. My bank. I'll credit my bank 1,000 and I'll debit equity of 1,000, because we withdrawing money from the business. So our equity is going to reduce, and because we are withdrawing bank, our bank is reducing. Our bank is reducing. I credit bank. Our equity is reducing. I debit equity. Now to the next transaction. Sales goods in cash for 3,100. Sales goods in cash. This is very straightforward. We have two accounts to open for this. We open our sales account and we open our cash account. When you are selling in cash, you open cash account. When you are selling, you open sales account. So what is my sales? I have opened my sales account before. I will look for it. Okay, we have sales account from the previous financial year. I'll come here again. sales account. Can you tell me what was the balance again? I can't hear you. Sales account. That's 5,500. The balance brought down for sales account is 5,500, and now we are making another sales again. We are making another sales. So excuse me. Yeah, we are making a cash sales of 3,100 again. So I'll come here, cash 3,100. When we sold goods for cash, it means for 3,000, it means our cash is going to increase. So once our cash increases, what do? We debit it. So I'll go to my cash account and I'll come here, I'll write sales. How much? 3,100. So I debit my cash, I credit my sales. I debit my cash 3,100 and I credit my sales 3,100. The next transaction is transfer money from cash to bank. Transfer money from cash to bank. So money is transferred from cash. Who is giving out? Cash is giving out, bank is receiving. We debit the receiver, we credit the giver. So we are going to debit bank for 3,000. And I'm going to credit cash for 3,000. So this is it. Cash, bank is receiving and cash is giving out. I'm sorry if you can't see it. So I'm. Can you see this now? So so this is my bank. Cash is 3,000. Cash is 3,000, and the bank. This is my bank account. I'm going to debit it with cash of 3,000, and this is my cash account. I will credit it with bank of 3,000 because money is being taken from cash to bank account. Yeah, the next transaction is sales of goods on account, 2,900. Sales of goods on account. When you are selling on account, it means you are selling on credit. When you are selling on credit, you should always remember receivables. When you are buying on credit, you should always remember payables. When you are selling on credit, you should always remember receivables. So sales of goods on account. We open sales account and we open receivables account. We already have our sales account. So I credit my sales and I debit my receivables. Where's my sales? Yeah, this is my sales. I credit my sales with how much? 2,900. $2,900. So this is it. 2,900. So I'll go to my receivables too and I'll debit it. My receivables. So I'll debit my receivables and see sales of how much? 2,900. So this is my receivables. This is my receivables and this is sales, the corresponding entry of 2,900. Of 2,900. So this is the corresponding entry. This is my sales here. I credit my sales 2,900 and I debit my receivables 2,900. Payment of the loan installment of €1,000. and the interest of 60 euro from the bank account. So you are making payment from, now in this transaction there are three accounts involved, because we are making payment from our bank account, we are making payment for interest, and we are making payment for loan installment. So we open bank account, interest account, and loan installment account. The loan install yeah the loan installment, of 1000, and so we are making a payment from our bank account. So I'll credit my bank account because my bank account is coming down. I'll come here. Oh, sorry. So my loan installment, how much is the loan? 1000. We got this. We got, if you recall that last in the previous financial year, we got a loan of 6000 from the bank, and we are paying it instrumentally. We are paying the loan, we are paying the installment, and we are paying the interest. So now for this year too, we are going to pay the loan and interest. The installment we are paying for this year is 1000, and the interest we are paying is 60. So this is my bank account now. This is my bank account. So I'm going to create my bank account because the money is coming from my bank account. Loan and interest. So I'll go to my loan and interest account and debit them to with bank. I'll go to my loan and interest. I'm not sure you can see that clearly, but please kindly bear with me. So where's my interest account? My interest from the previous year was how much? Was 60. Interest account. The interest is an expensive, so balance brought down 60, bank 60. So this is the balance from the previous year, and now this is the balance, the payment you are making for this financial year, 60. That's for interest account. Then I'll go to my long-term loan account. We call that in the first financial year, we got a loan of 6000, and out of the 6000, we transferred 1000 to our short-term loan, so our balance was 5000. And now, this is our balance for this financial year of 1000, and then we are now making another payment from the bank account. We are making payment again from the bank account, so if we reduce our loan, because we are owing 5000 and we now paid 1000 from our bank, so it will now remain 4000. So I'll come here, bank. So out of this 5000, we made a payment of 1000. Now post the entry for depreciation. Depreciation is annually. We had depreciation the previous year, so we are going to have depreciation again this year. So for depreciation, we debit depreciation account. Let me open depreciation here. So my balance for the previous year, balance brought down of 400. depreciation was 400. So the depreciation will always be the same annually. It will be the same. Now furniture, depreciation was on furniture. So this is my depreciation account. This is my balance for the previous year was 400. Now the depreciation for this year is now 400. Recall that the depreciation we are talking about is depreciation for furniture. So since I'm debiting depreciation here, so I'll go to my furniture and credit furniture for this year. Depreciation will always reduce your asset every year. Every year, it's a fixed amount that will always reduce your asset every year. So I'll go to my furniture account and reduce it with 400 for depreciation. So this is my furniture account, and I'm reducing it with 400 for depreciation. This is my 400 for depreciation. So this is my furniture account. Now the next thing is, at the end of the year, the inventory value is 1,900. Increase in inventory. No, okay. Inventory value. We are going to open change in inventory account. The inventory value is 1,900. So we open change in inventory. The inventory value is 1,900. The corresponding entry is also inventory. This is change in inventory. The corresponding entry is inventory. So let me open it here. I really don't get this, but this was how Lisa did us in class. She opened change in inventory and inventory account. So she put this one on the debit on the credit side, because inventory, this is a closing inventory will have a debit balance, so a credit balance. So she put this on the credit side and the corresponding year of the corresponding entry of this on the debit side. So now the last transaction is transfer the next year's loan installment from long-term loan. From last year we transferred 1,000 from our long-term to short-term. So we are going to do the same this year. Transfer a loan of 1,000 from our long-term to short-term. So where's our long-term loan? This is our long-term loan. This is our long-term loan. So we are going to transfer 1,000 again. So I'll come in a short-term loan. 1,000. So we are transferring 1,000 from long-term loan to short-term loan. So long-term loan is, if we are reducing our long-term loan, so since we are debiting long-term loan, we are going to credit short-term loan. So I'll come to short-term loan here. Okay, our short-term loan is not here. So I'll open another account for short-term loan. So what was our account? What was our balance from the previous year? Our balance from the previous year was 1,000. This is our balance from the previous year, 1,000. So another 1,000 again is coming from long-term loan. So I'll come in again. Long-term loan. So I have debited my long-term loan and I have credited my short-term loan. So this is the transaction for the second financial year. Before we proceed to the third financial year, we are going to do the income statement and the balance sheet. But that will be in the next video. Thank you so much for watching my video. Bye.